Whether you are planning your personal budget, evaluating an investment, or analyzing a company, these financial formulas will help you achieve financial clarity and confidence. Let's dive into them. Let's look at the formulas. Number one, savings rate. Savings rate is calculated by dividing the total savings with gross income and times 100. The purpose of savings rate is to determine, or the purpose of savings rate is to see how much percentage of income can be saved over a period of time. The second formula is current ratio. Current assets divided by current liabilities. Current ratio is used to determine the ability of an individual or a company to pay their short-term obligations such as debts with their short-term assets. Third one is emergency fund ratio. Is calculated with liquid assets divided by monthly living expenses. The purpose of emergency fund ratio is to see an individual's ability to survive on their liquid assets during an emergency. Next is housing ratio 1. Housing ratio 1 is calculated by dividing monthly housing costs with gross monthly income times 100. So what are monthly housing costs? Monthly housing costs are those, for example, if you own a home, you pay principal, interest, mortgage, basically principal and interest and property taxes and insurance, right? So you have to take those into account and you divide them with your gross monthly income times 100. Basically, the value should be equal to or less than 28%. If it is below or equal to 28%, then that is good. Housing ratio 2. You take housing ratio 1, monthly housing costs, PITI plus your other debt payments divided by your gross monthly income times 100. The value should be less than or equal to 36%. Return on assets, ROA. Return on assets is calculated by dividing net income with total assets times 100. Net income is the income where you subtract your total expenses from your total revenue. That is net income. So it measures how efficiently a company uses its assets to generate profits. Return on investment. Net income or net profit or gain divided by investment cost times 100. It evaluates the profitability of an investment. Investment assets to gross pay ratio, IA by GP. It measures the proportion of an investment asset relative to income. Basically, it is used to calculate the financial preparedness of an individual. Rate of return is calculated as like this: 1 plus nominal rate divided by 1 plus inflation rate minus 1. It reflects the true return of an investment after accounting for inflation. So these are the 9 formulas that are critical for a financial planning process. Thank you, and I'll see you in the next video.